Welcome back to our channel. Today, we're diving into the world of finance to discuss how to become an accredited investor and exploring the advantages and disadvantages that come with this prestigious status. My name is Peter Harris. I'm a venture capitalist at University Growth Fund, where I've invested in over 100 deals and trained hundreds of students over the last 15 years. Before I jump into this video though, I want to hear what questions you have about accredited and non-accredited investors. Pop down in the comments and let me know. And while you're down there, don't forget to like this video and subscribe to the channel to get more great videos like this one. And stick around until the end and I'll share a way that you can get this coveted status without being super wealthy. So, what exactly is accredited investor? Well, an accredited investor is a person or entity that meets certain income, net worth, or other criteria set by the Securities and Exchange Commission, or the SEC, allowing them to invest in certain securities that are not registered with the SEC. Non-accredited investors can invest in stocks and bonds, but as an accredited investor, you can invest in a wide range of investment opportunities, including private equity, hedge funds, venture capital, and more. These opportunities offer the potential for high returns and increased diversification. Now, you might wonder why you have to be an accredited investor to have access to these other investment opportunities. Is it just another way that the rich get richer? Well, kind of. But the real reason is that it's essentially a protective measure. Given the higher risks involved, these investments are reserved for individuals deemed financially sophisticated, people that can assess the risks involved and afford to take losses if things don't work out. It also safeguards those with limited financials from potential losses that could prove detrimental. Now, let's break down the requirements to become an accredited investor. The SEC defines an accredited investor based on income, net worth, and now, under new provisions, expertise. For income, an individual must have earned over $200,000 in each of the past 2 years, or have joint income with the spouse exceeding $300,000. Alternatively, an individual must have a net worth exceeding $1 million, excluding the value of their primary residence. Now, it's important to note that the definition of an accredited investor recently underwent changes, as announced by the SEC on August 26, 2020. According to the SEC's press release, the amendments now allow investors to qualify as accredited investors based on defined measures of professional knowledge, experience, or certifications, expanding the list of entities that may qualify. These new criteria are really exciting because they increase the possibility of attaining accredited investor status to more than just the wealthy. These new criteria include having certain professional certifications or designations recognized by FINRA, such as Securities Representative License, Series 7, an Investment Advisor Representative License, Series 65, or a Private Securities Offering Representative License, Series 82. You can also achieve accredited investor status if you are an investment employee at a private equity, venture capital, or hedge fund. Once you meet the accredited investor requirements, then what? The process of verifying accreditation typically involves completing questionnaires, providing financial statements or tax returns to verify income or net worth, and sometimes obtaining attestation letters from financial professionals like your accountant. Additionally, if you're claiming insider status or professional credentials, you'll need to provide evidence to support your qualifications there as well. Each investment opportunity may have its own specific requirements for accreditation on top of this. Really, it's just driven by the investor or the company that is receiving your investment. Now that we understand what an accredited investor is, what is a non-accredited investor? A non-accredited investor, simply put, is an investor who falls short of the criteria we've just outlined. They represent the majority of investors worldwide, comprising individuals with assets under $1 million and incomes below $200,000 annually, essentially constituting the bulk of retail investors. The SEC's regulations wield significant influence over the investment landscape for non-accredited investors. They dictate what these investors can invest in and establish transparency and documentation standards for such investments, thereby safeguarding non-accredited investors from potentially risky ventures that they may not fully understand. Think about these laws as measures to protect your grandma from unscrupulous people seeking to steal from her under the guise of a guaranteed winning investment. Think Ponzi schemes and other white-collar crime are the reasons why these regulations exist. In particular, non-accredited investors encounter restrictions when it comes to investing in private companies and funds. Private funds and companies predominantly engage with accredited investors due to their access to large amounts of money and their financial sophistication. They will require that you are accredited before letting you invest because if they don't, it can open them up to significant liability, especially if the investment fails to deliver the expected return. The non-accredited investor could claim that they were taken advantage of and take them to court. But non-accredited investors still have access to great investment opportunities like bonds, real estate, public equities, and other securities. They also can participate in real estate and equity crowdfunding opportunities. If you do qualify to be an accredited investor, it's important to weigh the pros and cons of making investments in that realm. First of all, let's talk about the perks. Access to unique investment opportunities. One significant advantage is access to unique investment opportunities that are not available to the general public. These could include early stage startups, private equity deals, hedge funds, and exclusive real estate ventures. With greater risk comes the potential for higher returns. Accredited investors often have the chance to earn substantial profits from their investments, surpassing the returns achievable through traditional investment avenues. Frankly, this is one way in which the rich do get richer, while the majority of people lack access to these opportunities. Increased diversification. Diversification is a key to robust investment strategy, and accredited investors have the opportunity to diversify their portfolios across a broader spectrum of assets. This helps spread the risk and optimize returns over the long run. Now, let's shift our focus to the drawbacks associated with accredited investing. High risk investments. Now, just like we mentioned, the potential for high return usually is correlated with high risk. One of the primary cons of an accredited investments is that they tend to be high risk. These ventures are often early stage companies or speculative ventures, increasing the likelihood of capital loss. High minimum investment amounts. Additionally, accredited investments typically, although not always, require high minimum investment amounts. This means investors need to commit significant capital up front, sometimes millions of dollars, which may not be feasible for everyone. High performance fees. Accredited investors may also incur high performance fees charged by investment managers. These fees, often referred to as 2 in 20 model, consist of a management fee and a portion of the investment profits. When it comes to public equities, these fees tend to be a lot lower. Long capital lockup time. Finally, accredited investments often come with long lockup periods during which investors cannot access their capital. This lack of liquidity can be a significant drawback, especially in times of financial need. Once you invest in a startup, for example, it may take 10-15 years before you get a return on that investment, assuming it's successful. So, as you can see, the decision to become an accredited investor involves weighing these pros and cons. Do you really need access to these investment opportunities? Or are the opportunities available to non-accredited investors sufficient for your needs? Well, the potential for high returns and access to exclusive opportunities may be enticing. It's essential to consider the associated risks, fees, and lockup periods. In conclusion, accredited investor status isn't for everyone. It requires significant wealth and financial sophistication. While it opens doors to unique investment opportunities, those investments also come with increased risk and costs that you should be aware of before making those investments. And non-accredited investors still have access to great investment opportunities. That said, having the investment optionality of an accredited investor is great and is something worth pursuing. If it is something you decide that you want and you haven't achieved the wealth or income requirements yet, consider taking the Series 65 exam. It's not too difficult, and unlike the Series 7 exam, you don't need to work at a sponsoring financial institution in order to get the license. You just have to take the test. Well, that's all for today's video. If you found this information helpful, be sure to like this video and subscribe to our channel for more investor and startup insights and tips. Thanks for watching, and we'll see you in the next one.